Welcome to day 5 of the Gold Summit. Today's guest is a self-styled independent researcher of the international gold market. Jan Nieuwenhuijs has a 10-year track record of analyzing the raw data to expose conclusions that surprise veteran gold traders, gold bugs, conspiracy theorists, and institutions alike. He publishes his work for free at Money Metals. In this interview with Nick Hubble, Jan explains a model of the financial system called Exter's pyramid. He claims that gold plays an underappreciated but crucial role in our financial, monetary, and economic system. That system has become top-heavy with printed money, debt, and financialization. There are 2 ways to fix this: a debt crisis that reduces the amount of debt, or a revaluation of the gold that forms the foundation of the pyramid. Jan argues the latter is a preferable solution, and investors will be able to profit from the coming revaluation of gold by an order of magnitude. Over to Nick Hubble and Jan Nieuwenhuijs to explain why.
Jan, it's good to see you again, but I'm very disappointed we couldn't convince you to come to London and leave your Caribbean home.
Yeah, I wanted to come to London, but there were no flights left. Otherwise, I would have come, of course. It's winter there, right?
You didn't invite us to the Caribbean for the Gold Summit.
Oh, yeah, sorry, I forgot you.
Okay, let's dig into your very surprising and unusual thesis for gold in 2025. I'm going to read it out. The deleveraging of the global financial system, both by East and West. So that's a reference to how much debt there is in the world. Why did you choose that as your topic? Because I was expecting 2 other ones, and I had all my questions ready for you and notes ready for you, and then you sprung this on me.
Well, this is how I see gold. I think I'm a gold analyst now for 10 years, and a lot of analysts, especially equity analysts or other analysts, have a very difficult time to analyze gold and how to value it. And I came up with a very, let's say, simple theory about what gold is and how it works, and it has to do with Exter's pyramid and the hierarchy of financial assets. So in the economy, you have goods and services, and you have financial assets, financial instruments, such as bonds, equity, national currencies, gold. Commodities, not really. That belongs to the goods and services part. And derivatives, of course. Now that you get a hierarchy of financial instruments because, not so long ago, 150 years ago, for example, there was a gold standard, and, the gold was the foundation of the economy. Based on top of that, they had national currencies. The national currencies could be used to buy equity or bonds. If you want to sell your equity, you sell it for national currencies or bank deposits. Then you take the national currency out, you go to the central bank and get the gold. So, and the gold is no one's liability, right? In essence, if you have your gold stored somewhere, then, you have a liability from your custodian. But in essence, the gold in the financial system is the only asset that is no one's liability. So therefore, it is not credit. It has no counterparty risk. It is not credit. All the other assets on top of it, like national currencies, bank deposits, equity, bonds, it's all credit and it's all debt. So if you visualize this inverse pyramid from Exter, you have a tiny triangle, that's the gold. Then comes the national currencies, the equity, the bonds, and the derivatives. It all rests on, because everything in economics is pretty much about trust, right? I mean, you're in London now, maybe today you get paid in pound sterling, trusting that you can the next day spend it at the grocery store. So it's all about trust. But, in the end, we can't build a financial system on derivatives, right? There's too little trust in that. So it all rests on the trust of gold, which has no counterparty risk. Now, what has happened in the past, let's say after the breakdown of Bretton Woods, even during Bretton Woods, is that this inverse pyramid began to widen. So a lot more national currencies were created. Equity was issued, more derivatives, and it's now, it has the shape like this. So that means leverage in the system, also because a lot of foreign exchange or a lot of national currencies became reserves as foreign exchange for other countries. It became leveraging on leveraging on leveraging on leveraging. So the pyramid looks like this now. And you see, so there's a lot of debt in the system, right? China has a lot of dollars of the US. That's credit, that's debt. Not only, if it weren't bonds, if they would just hold dollars in physical form or bank deposits, it's debt as well, because it was a trade. They did a trade that the US didn't settle with something tangible, so the fact China holds foreign exchange, US dollars, is a loan to the US government, to the US. So all this credit and all this debt created debt saturation, so less growth. But now also, because of all the imbalances in the world, the wars are also tearing down, the deleveraging. So Russia wants to hold, it can't hold any dollars or euros. China and all the others are also like, we like dividends, or interest rates on bonds, but we see the risk of it and we prefer to have gold. So how to deleverage this inverse pyramid is not by deflation and let everything collapse, because that would be, nobody knows what the end of that disaster is. It's done by raising the price of gold. And then the tip becomes larger and the pyramid changes in shape until it is restored in a form that symbolizes stability. So that is what I meant by deleveraging of the global financial system. And that is why I think gold will go up in price, because they can't tolerate deflation. They can't tolerate the equity market going down 70%. They can't tolerate, goods and services going down in price. The only option to restore the pyramid is a significant rise in the price of gold. And I have calculated that would mean you can take several ways to approach this, but I think the price of gold needs to go to $8,000 an ounce, giving all the exchange rates in the world stay like this. And then you get something of a system that is a lot more trustworthy than the words of the US president.
Yeah, a lot more stable. This is exceptional. I haven't heard this explanation before. So if they don't want the pyramid to tip over, to fall over, because it's not stable after having become so wide, they don't want the amount of credit and debt to contract so that the top of the pyramid gets smaller. The only way to return the pyramid to a more stable position is to have the gold price increase, because that's the base. So it's such a simple way to think about it. I want to make clear, you're talking about both public and private debt and like you said, all the different currencies. So it's all thrown in one big giant pyramid.
Exactly.
Yeah, and the gold price rising is almost a solution to, it's like the pressure valve, the way you're portraying it, to all of these, normally, historically speaking, we'd have a debt crisis of some sort or an inflationary crisis of some sort, right? Are you saying then that we don't need to go through those processes if the gold price rises sufficiently?
It could be. I mean, if you get a lot of inflation, then the gold price rises relative to the national currency. So the pyramid does this as well. It's just that, I don't see, there's so much debt in the system that they can't do it through austerity. They can't raise taxes. They can't raise interest rates, right? It's all very difficult. And one way to also internationally, if you look at the tension between countries now, which is, you could say, if you get global imbalances, sooner or later, you're going to get tensions, right? So maybe the wars are a result of the pyramid being out of shape. And I think the most logic way, and, also others like Ray Dalio also said, usually it's inflation and yield curve control that deleverages the system. Now, everybody has its own words and its own model, but this is like my model after thinking about it for a couple of years, and it's a simple model. It's a global model because it also takes into account the balance of gold to foreign exchange reserves by countries. If you like a country, if they not only with gold but also can use foreign exchange to cover their monetary base and secure their domestic economy, then of course that's more leverage to the system. But that has been going on since, let's say, the 50s, when the US started exporting dollars in large amounts, and then also the euro dollar system. But that is always a bit of a complicated story, so let's not go in there. But yeah, that's how the global financial system has been leveraged, and that is how we get geopolitical tensions, wars, debt saturation, low growth. I would even dare to say, because of the unconventional monetary policy that they've thrown at it, you get societal disorder, you get inequality, you get social instability and whatnot. So yeah, maybe, I'm too simplistic, but I see that as a natural way for the system to heal itself. And also, if you get to that point, and and people, their memory is like, oh shit, we shouldn't accumulate foreign exchange anymore because it's risky, then for probably a period, international trade is being settled in gold, right? So, and then you won't get global imbalances for the time being. But maybe we learn from history. We never do, but it's likely that we'll first reset the global financial system by deleveraging it, and probably in another few decades, in 50, 60 years, we're back to square one. But of course, I don't have a crystal ball.
Yeah, this is exceptional. I haven't heard it before, so you've blown my questions out the water, because I thought you were going to be talking about either a 2008 style crisis or an inflationary crisis of some sort. This is fantastic. So explain how gold allows the system to deliver or solves this problem of too much leverage. So I can think of a few ways. For example, if the gold price increases substantially, that gives central banks a huge amount of assets because they tend to hold a lot of gold. Gold can be used as a settlement mechanism for trade surpluses and deficits. So countries don't need to trust each other's currencies. Russia trusted the US dollar, and that didn't work out very well. Countries don't need to trust each other's currencies to settle trade. Are there any other ways in which gold's excellent characteristics, as it's not debt, it's not credit, doesn't require any counterparty, how are these characteristics solving the problem of too much leverage in any other ways?
Good question, because I think I have a proper answer, and that is because gold is already part of the system, and it's good collateral. So if you take, for example, the European central banks, but it doesn't matter, but the European central banks have been accumulating gold primarily in the 1950s and 60s. So they bought it for, let's say, $35 an ounce. Now, at the moment, the gold price is $2,600 an ounce. So there's a big revaluation of the gold price. Now, if it goes even further to 5,000 or whatever, what happens is that central banks, they have an asset side on their balance sheet and a liability side. So on the asset side, there is gold. If the gold price rises, that makes their assets a lot more. But then also something else needs to change on the liability side, and that is recorded in what is called a gold revaluation account. And that is simply unrealized gains on gold. But that is equity of the central bank, and they can use that. Only central banks can use it because they are the monetary wizards of our universe. Central banks can use that equity and make money out of it. They can spend it, whatever. But they can also use it because, as you have noticed in the last, 15 years, there's a problem in the economy. one way or another, the government either, the government bails out banks or bails out companies and whatever, then the central bank buys the government bonds. So all these government bonds, this, let's say, surplus in debt is on the balance sheets of central banks. Now, how to get rid of it? That's on the asset side. Now, if you take a red marker and wipe out, the gold revaluation account, you can also wipe out the debt that the government owes to the central bank. So you can clear the system. So it's really this yin and yang between credit and gold. And it sounds so simple, huh?
Yeah, but that's what's so striking about this. When we organized this Gold Summit, we thought we wanted people who don't just sound like a broken record for decades. And you've been an original thinker on gold especially. But this idea is really surprising because it offers an easy way out that I've only been told doesn't exist, right? Because if we have inflation, it causes all sorts of turmoil. And we've sort of lived through a taste of that recently. Deflation is a nightmare. But how else are we going to deliver? Are we going to default? What are we going to do? There's no easy way out. And you're saying a significant revaluation of gold, that's probably not an easy way out, but it's probably the easiest politically, economically, financially, all these different ways. So it's such a fascinating idea. Why do we need to deliver?
Easy. I think it never will be easy. It will come with a shock. But if you own a home now, a house, good for you. There are a lot of people where I'm from, the Netherlands, that don't own a home. The price didn't go up for them. They don't have a lot of equity. They feel desperate, right? This is what the system has done. A lot of people think, oh, there's no, everything went fine the last couple of 10 years. No, a lot of people are unsatisfied. Sorry, you were asking a question.
No, that's a good point, because it's been a redistribution of wealth across society, and the part that's benefited believes that society as a whole has benefited. They don't realize that it's been a redistribution. I wanted to ask you next about the reason you felt the need to mention in your thesis that it's both by East and West. Most people don't focus on the East, obviously. I know you do in your research a lot, but why did you specifically mention those two?
Well, because they're all in the same boat. Maybe China's public debt isn't that high, but it has a lot of foreign exchange reserves. It has a lot of dollars that it's stuck with, right? It's all the same debt credit surplus, so to say. Too much credit in the system that need to get rid of. Now, if the gold price rises, then China now has, I don't know, their gold reserves relative to total reserves are 5%. I don't know, maybe it's 4%. If the gold price rises, it's 50%. Then they are a lot less interdependent on the United States, right? All this foreign exchange reserves being held, export models, current account imbalances. It's a form of interdependency which is not suited for the current geopolitical climate. Sorry, what was your question? East and
why
West.
Did you choose East and West? Yeah.
So maybe that's that counts for China, but in the West there's a lot of public debt, and the public debt is being collected, is being, accumulated on the balance sheets of the central banks. Now, the West has the advantage that they own the gold since the World War II. Sorry, so they can solve their debt problem through the public debt vault and the gold revaluation account. And that will actually, if the Chinese use all their dollars to buy gold, that would actually help the balance sheets of the Western central banks as well. So that's why I just wrote an article also, and it's about Europe is finalizing preparations for a gold standard, And you can read all the quotes from the central banks. They're very much pro-gold. They want you to buy gold. They want the gold price to go up, not too quickly. They're very candid about this is plan B. And, if anything happens, this is what we're going to use to build a new system. And so if anyone believes that the current system is sustainable, be my guest. If anybody believes that, there's turmoil in the world, whether that be on the front of war or finances or small growth, whatever, then, this story might be compelling.
Yeah, it's such a fascinating idea. Let's just quickly dig into that Europeans preparing for a gold standard idea, because it sounds like a silly conspiracy theory, right? And one of the things that's noticeable about your work going back is it often starts that way. It often starts as a research piece that makes people sort of shrug and smile. And then over time, it gathers this momentum. And then you end up being right. That's happened in the past with China and a couple of other issues. So take us through your claim that the European Union or Europe are preparing, you said finalizing just now, but whichever it is, for a gold standard.
Yeah, well, several things are happening in Europe. So first of all, everybody thought, oh, the Europeans were... I've also written about that there was a gold war in the 70s between Europe and the United States. Because, of course, then we had Bretton Woods and a lot of these European countries held dollars. And then the dollar pegged to gold was broken. And then they saw their dollars devalue against gold, They might as well, or they were better off if they would have all redeemed their dollars for gold. Of course, Germany couldn't because it was being defended to the Soviets by the US, and there was blackmail operations and whatever. It's all military power. But there was a gold war. And one of the reasons that Europe couldn't push through a gold standard back then was, first of all, the military strength by the US, but also they had the most virtually all the gold, monetary gold in the world was in Europe. Now, if you start over with a monetary system and you own all the money, then it's going to be unstable from the start. As an example, I always say, like in the 19th century, there was a classical gold standard, and along the century, more and more countries joined the gold standard, and demand for gold increased. So the price of gold actually went up. But if that is your currency, then you get deflation, right? What we call deflation in terms of goods and services going down in price, denominated in gold. So if you start a monetary system like the classical gold standard, but only a few countries are on gold already and the others have to buy in, you're going to get instability. Now, I'm not saying that a little deflation is bad. I'm just saying that it's very important to spread these gold reserves if you want to have this as plan B. Okay, so in 1992, the Dutch central bank sold 400 tons of gold to the Chinese central bank. And in their annual report, they said, well, we looked at, big economies, large economies in terms of GDP, and also important countries, Germany, France, the United States, Switzerland, whatever. And they assessed that they held too much gold relative to the size of their economy. Then it went on. What the Europeans did in the 90s is sell gold because there was predominantly middle-sized economies like Austria, Belgium, the Netherlands, who sold a lot of gold because proportionally to the other countries, they held too much. Then the market became a bit nervous about all this selling. And then the central bank gold agreement was signed in 1999. And the European Central Bank said, look, okay, calm down. We're just going to sell 400 tons each year over the next 5 years. And, and immediately the gold price went up because the market was reassured about the future. They called that the central bank gold agreement. They called that a coordinated program of sales. What it actually was a program to equalize gold reserves among countries, because in Europe, all the gold reserves were equalized relative to GDP. The gold was sold to the East for a large share, which historically had very little official gold reserves. And even in China, for example, the East had, of course, a lot of gold from past centuries, but under communism in China, the people had no gold, the government had no gold, etc. So there was a lot of rebalancing that needed to be done, and that is happening until this day. So this rebalancing has been confirmed by several central bankers, and I've put them all in the article. You can read all sorts of quotes that they're rebalancing these gold reserves according to GDP. What they also started doing after 2008 is refine, we know that of Germany, France, and Sweden, maybe I forget some countries, of Poland, for example, that they came out and said, well, all our gold bars adhere to current wholesale industry standards. In other words, it's liquid, and if we need to deploy it, we can do so in international markets right away. That's a signal. Then what they did is also repatriate gold. Like, okay, this is important. We need to take care of security, cost efficiency, liquidity, etc. So it's good to have something in London to settle things with, or use it as collateral for whatever. But we need to be secure as well, and have this economic sovereignty and put a lot of gold on own soil too. The other thing is they started communicating about gold very differently. So all the quotes I just referred to as well, like it's all in the article, but for example, the Central Bank of Italy says, well, gold is an excellent hedge against adversity. Whatever happens, it retains its value, which is not to say about national currencies, which are, issued by a government that can go belly up. And it's a central bank saying that. I mean, what else do you want to hear, right? You want them to put an ad in the newspaper, or the Dutch central bank saying, gold always retains its value. If the system collapses, we can use it to build a new system of exchange rates. And I can go on and on and on. The German central bank saying gold is the bedrock of the global financial system, which ties into this whole, view of how all financial instruments, of the hierarchy of it, and how it's how it can be stable or unstable.
For me, the giveaway is the proportionality to GDP, right? Because if you're going to relaunch this gold standard in Europe, you want everyone to start with from the same level, but it's not the same amount of gold. It's adjusted for the size of your economy. So the fact that they're doing that harmonization means they must be planning for something. There must be something that follows on from that harmonization completing. So are they close to completing it?
Yeah, they are. Yeah. Poland needs to buy. Well, the thing is that you can harmonize it completely, but then GDP levels don't grow at the same pace, and they can't every year buy a little gold, sell a little gold, country for country. So it's more or less that they more or less have the same all over, and they could even choose, because in the Eurozone, for example, it's a lot of it is about solidarity. So they might even revalue gold to restore the pyramid, and then before revaluing it, exchange foreign exchange for gold between them, so they have exactly the same amount what they need, and then enjoy all from the revaluation and go from there. So they're pretty much finished, and actually, it's their plan B, but it will only work if the rest of the world also has the same plan B. Right? Because they trade with the rest of the world. If only Europe holds gold and something happens and they want to go on the gold standard, well, fine for them. But the rest of the world maybe does something else. And it's to their benefit that the rest of the world holds the same plan B.
Right. So the Western world is focusing on this idea of we have too much debt, especially government debt. So we need to revalue gold as part of the solution.
Europe, not the US. Of course, the US doesn't want to talk about all this.
Let's focus on the US instead then, because that's more interesting. So you're saying that the US does not want this revaluation of gold to occur because they want to have their exorbitant privilege, as it's known, of printing US dollars and being able to use this as a trade currency. So how does that play out geopolitically? If Europe's preparing for the gold standard and the implicit idea is that they're going to revalue. What's the US going to do? What are they thinking here?
Well, first of all, not sell their gold, which they haven't done in, since the 1970s. They haven't sold an ounce of gold. I mean, they're not refining it. It's all in, old bars and crappy, and it's not liquid and etc. But they're not selling it, right? They're just pushing back, and they just want to, their superpower depends on the dollar and military strength, and both feed them, because the more military strength they have, the more they can support the dollar. The more the stronger the dollar is, the more money they can print and also support the military. So they want to keep things as they are. But of course, turn on the news, or actually not the news. This is not so much on television, but maybe you can look on the internet to all the things that happen in the world. And also, some people were hoping that Trump would de-escalate, the wars, but we have yet to see that he will bring peace in the Middle East. And and that is all. The more countries hate the U.S., the more, even if they have to make a loss on it, they will ditch the dollar.
So Jan, bring all this back to investors for me. Is this very simple? In the sense that investors just need to own some gold to benefit from all of this, or is there something a bit deeper?
No, I think if you're an investor, I'm not a financial advisor. I'm a gold researcher, but I would certainly keep gold in your portfolio as because every portfolio is a pyramid as well, right? You start with something with no counterparty risk, with no return and no risk, and then you add your flavors according to your risk profile in terms of, you want to buy Bitcoin or shitcoins or, So, but I think it's important to have physical gold stored outside the banking system, because, always when there's a crisis, it happens in a weekend, you can't reach your gold when you need it. And hold that as an insurance to your portfolio.
Yeah, and this has been excellent. I was surprised and fascinated. How can people find out more about you and your work?
Well, you can follow me on X. I'm daily active there, and I publish my research on the website on the news roll of Money Metals Exchange, which is a physical gold and silver dealer in the United States.
And I highly recommend going back through some of the archives of Jan's work, because so much of it is still relevant. It'll help you to understand what's going on in the geopolitical world, but also in the gold world. Jan, thanks very much for joining us from the Dutch Caribbean. Everyone at home, thanks for watching this episode of the Gold Summit.
Thank you, Nick.